Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities, and historical data, all delivered via API, XML, and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to Econoday Unplugged. It's Tuesday, the 30th July 2019. Mark Pender is stateside and I'm Jeremy Hawkins here in London, where the pound's been falling almost as fast as the rain as new Prime Minister Boris Johnson toes the hard Brexit line. Well, this is a really bumper week for market watchers, including policy statements from the Fed tomorrow, Bank of England on Thursday, alongside a new US employment report and both preliminary GDP and flash inflation data out of the Eurozone. And of course, we have US-China trade talks too. So I guess after all the speculation, the Fed has to come first. So, Mr. Pender, final thoughts on what they might announce on Wednesday. And perhaps before that, what do you think of the first look at the second quarter GDP numbers on Friday?
Well, they were very strong. It was in consumer spending that really showed a lot of fire. A 4.3% rate, that was 0.4 above Econoday's consensus, really drove the quarter.
More reason for a Fed cut, then.
Well, less reason. Everything else in that report is really kind of peripheral if you think about it. Mm-hmm. I mean, two-thirds of it is consumer spending, and that's tied to the jobs market, which is very strong. We just had consumer confidence report today, and it had a big unexpected jump in that. And that included really positive assessments of the jobs market. So as far as what the Fed is doing, they're not responding to incoming data. They're responding to some kind of a perceived risk or that business investment perhaps might be slowing. Although in the GDP report, it really wasn't that bad, and it has been very solid. Whether or not the manufacturing sector will suffer because of the constriction going on in global trade, well, that's probably a positive, and that's probably something that is happening. And so there is a reason, I guess, to cut interest rates, although it would be highly anticipatory. And it also has, it has a bad feel to it. It's not like the Federal Reserve is standing up for itself. It really has in tradition, been a center of reason and common sense and cooperative policy at that kind of a group level. And now that might be going out the window, definitely. It's being shown with the Trump administration calling now for a 50 basis point cut tomorrow. It's just kind of shattered. It's not really as so much of its credibility as its institutional tradition and where it stands. So it's really moving in line with political moves at the same time that fiscal spending is absolutely through the roof. So we had the core inflation today. It did a small uptick, 1.6%, going to the 2% target relative to the 2% target. The core on a monthly basis almost made a 0.3, which would be very high. But inflation is basically a flat, and that does give them room to lower rates. But they're doing it in sync now with the ECB, and I guess even what you were talking about. You've been talking about the Bank of England, and now there's even talk there. I guess we should shift to that. But in general, it's kind of an odd time right now. We're going to get Jerome Powell's press conference tomorrow. We have strong GDP. We have strong consumer spending. We have a strong labor market. Phillips must be spinning in his grave because, the unemployment rate is expected to go to 3.6 on Friday. We're testing the capacity of the labor market.
It really makes me wonder. Let's suppose looking to Friday, and perhaps you give us a quick spiel about what the markets are looking for and so on. But if we were to see, let's say, a particularly strong payroll and, let's say, a jump in average earnings, then surely the bond market has got to take it negatively. It must have, after the Fed presumably has just cut.
If they think, or if there's the view that the Fed's rate cuts would then diminish or would then reverse or would then stabilize, what's going to be important, I guess, tomorrow is going to be how the outlook they give. What's interesting, we have the employment report on Friday. And in the past, bits of the employment report can be released to the Federal Reserve and to the Treasury. So they may be getting a peek at some of that report. Okay. That's just conjecture. But I have seen those kinds of things over the years in the past, and they have special access. So as far as the chairman, so it is possible that that could be anticipated and could limit their how much they're willing to say that they'll cut in the future. But it's also now we're having talk that they're going to just immediately end quantitative easing. I mean, there's only a couple months to go. I mean, why bother? Showing this kind of a reaction, an overreaction, which is something central banks aren't supposed to do. And so it's not a really great time for the tradition of the Federal Reserve. And Jerome Powell has to take, he's the Trump appointee. He's the inside man. He went with the institution, and now he's flying back the other way, or it certainly would seem that way. So I don't think that this is really the Federal Reserve at its greatest moment. But I don't want to talk about that. Let's talk about the Bank of England.
Okay, well, perhaps just before we get to the BOV, just quickly sum up the ECB, which was sort of the first of the big four central banks to announce. They made their statement last Thursday. And what have they done? Well, as Mark was talking about possible coordinated rate cuts, the ECB didn't actually come out and ease per se last week. But what they did, they really left everything looking set for a possibly broad base ranging stimulus once we get into their next meeting, which will be in September. So no change in official interest rates last week, but crucially, they did modify their forward guidance, which now includes the possibility of lower rates. And that's something they haven't included, until we go back to around about 2017 time, if memory serves me correctly. They also talked about that they'll be setting up committees looking into a range of additional measures aimed at boosting inflation back to target. So the bottom line of all this is that it now seems extremely likely that September will see a full-blown ease, probably encompassing both a cut in interest rates, which would mean, of course, that the benchmark refi rate would finally go into negative territory for the first time, as well as a fresh round of quantitative easing. And it'll be interesting to see what kind of assets they include in that, because it may be they'll expand it perhaps to include equities. With regards to Bank of England, then, well, this is one of the interesting ones, because as things currently stand, they're kind of still pointing in a different direction. As we talk, of course, there's still the fug that is Brexit hanging over the meeting. And markets really, I suppose, may be looking for the Bank of England to follow the expected easing by the Fed tomorrow and the ECB in September. But the BE's attitude at the moment does appear to be rather different. And what they're concerned about is really what we call the output gap. So how actual output stands in relation to how output can actually perform when it's doing as well as it possibly can. And the Bank of England's view is that, well, to all intents and purposes, this gap is pretty well closed. Now, what that means, if they were to come out and provide additional monetary stimulus to boost demand, because output couldn't respond in any time soon, it would need to increase in productivity or higher investment before that could happen. The first round reaction would be an increase in inflation. So as things currently stand, the bank's view appears to be that it's more likely at this stage that interest rates will go up, not for the time being certainly, but more medium term they see interest rates more likely to go up than to go down. Now, I think for a lot of people looking at good old Brexit, and we're back on that again, The view has been that were we to get a hard Brexit, then the bank would be forced to cut interest rates because of the damage that such a move would do to the real economy. And certainly now we have Boris Johnson installed as the new Prime Minister, and he's very much surrounded himself by, if you like, hard Brexiteers. Indeed, if it was no surprise that Johnson won the battle for the leadership last week, there was certainly a good deal of surprise about just how much of Theresa May's cabinet was culled. In fact, about half of the entire cabinet is now sitting on the back benches, and their positions have been filled by people loyal to Johnson and folks who really want, just to get the UK out the EU as soon as possible. So the risk of a hard Brexit has very much increased, which I think from a financial market perspective has been perceived as increasing the likelihood that the bank will come out and cut interest rates at some point. But the bank's already made clear that if it's the case that we get a hard Brexit and the supply side shock, so the shock to output, is more damaging than any kind of hit we get to domestic demand, then we're still in the same kind of boat. The chances are that inflation could actually go up rather than down. So they're sticking to this view that interest rates may have to go up. Now, I think it's pretty hard really to see the bank coming out and raising interest rates if the economy were to fall into some kind of recession, but it's the kind of view they're talking at the moment. And I suppose in either event, perhaps suggests that, at least for the time being anyway, financial markets are a little bit too complacent that we will see UK interest rates going down, irrespective of what might be happening elsewhere in the world. So it's interesting. It's still very much politics at the moment. And obviously, all the talk over here is what's going to happen with Brexit. And as folks might have seen from the way the pound's been performing, it really has taken something of a right raw stuffing over the course of the last few days. And that's just really a reflection of the fact that Boris Johnson has come out all guns blazing, essentially saying what he wants to do now is to review and renegotiate the existing withdrawal treaty. So this is a treaty that Theresa May agreed with the European Union and includes this dreaded backstop, which he's completely refusing to accept. The EU is still maintaining, well, there's absolutely no way we're going to change this. We've told you that already. And so now I must say, the probability of a no-deal Brexit is certainly increasing. But as we've talked on this podcast, I suppose many times in the past, a no-deal Brexit, unless something changes, we have to get through Parliament. And Parliament's going to do its damnedest to try and prevent it. So it's still kind of anyone's guess as to what's going to happen over here. Wow. Really is still a right mess.
It is. But it's interesting that it seemed pretty clear that there would be an increase in the probability of a hard Brexit, but there seemed to be a reluctance to accept this view. But it's hard not to see anything else, really, unless, like you say, a Parliament intervention of some kind.
That's right, and it would have to be an intervention because saying that the bottom line, of course, well, the bottom line, I should say, is the fact that unless something actually changes, then we will be leaving under UK law, at the end of October time. So as we start getting closer to this end date, I mean, UK financial markets could be really volatile. And let's suppose, the Fed does one cut this week and that's it, doesn't cut anymore. The ECB's cutting interest rates, and you could really start building up quite a very strong positive dollar scenario where there are higher interest rates, an economy which is doing okay versus a complete mess right across Europe. Because Brexit is bad for the UK, but it's certainly bad for the EU as well, and negative interest rates in continental Europe too. So it's certainly possible. Knit it together, strong dollar picture.
Yeah. Well, the one thing though, it seems to if we have a coordinated or de facto coordinated interest rate cuts, it would have a coordinated effect on currencies. It would tend to keep the spreads comparable, and maybe would limit the volatility.
May do. Yeah. May do. I think that at the end of the day, investors can start looking around, well, how do we make any money? And if you're looking at continental Europe with negative interest rates, so you're actually paying for the benefit of holding an asset. Well, at least if you can actually earn some money when you're holding US dollar denominated assets. But as you say, it's going to be an interesting one because it really is sort of I'm not sure brave new world's the right expression, but it is certainly a new one as we go forwards. But I should quickly mention, I suppose, in terms of the numbers out of Europe this week of interest, we'll get our first look at second quarter Eurozone GDP, their so-called preliminary flash number. And it really is. It's very simple. Unfortunately, we don't get all the nitty-gritty of the national accounts like you do your side of the pond. It will just be simply headline growth numbers, quarterly and the annual basis. That's expected to show a 0.2% quarterly increase in real GDP for the Eurozone as a whole.
And what day is that?
That is due out on Wednesday, so that's tomorrow.
And today we had France, right?
Today we had France, which I must say was a little bit disappointing. The French economy of late actually has been doing relatively well compared to, well, certainly the likes of Germany. But it was the second quarter number was only 0.2% quarter on quarter. And that's as bad as we've seen in France since it last contracted several years ago now. And it just makes that little bit more downside risk as far as the Eurozone is concerned. Markets looking for sort of around 0.2 there, which should only be half the rate we saw in the first quarter. So again, it's just, this is the real reason, of course, why the ECB's having to cut interest rates. Wednesday, we'll also get the flash inflation data. So the first look at that for July. As expected to see inflation, again, hovering around about the 1% and ditto the core rate too. So again, despite everything the ECB's done so far, underlying inflation in the Eurozone really ain't going anywhere.
And just a real quick detail on GDP. So, and Germany's GDP isn't due until what, next week?
We don't get until, if I remember right, next week. That's right. Yeah.
And so tomorrow when we get the European, will they include any data on Germany?
Well, I think they'll put an assumption about Germany in there, even though they won't actually have. I suspect they'll have more data than anybody else will via the stats people in Germany who will provide them with some figures, but they won't be official figures, so we won't actually know what they are. But tomorrow we will also get the Italian second quarter GDP flash as well for GDP. So that'll be another of the big countries. So we'll start to get some idea about what's going on. But I suppose in many ways you've got to say that the key interest for investors in the Eurozone at the moment is Germany, because it's when we look at the PMIs, who's the bottom of the pile, it's Germany. And Germany's still getting on for 30% of Eurozone GDP. So where Germany goes, it's still the case that a lot of the Eurozone tends to follow.
And for the Fed, slowing in Europe and slowing in Asia. They're looking across the oceans, I guess, and that would speak to the need for a rate cut or preventative rate cut, I think. So that could be part of their argument.
I'll tell you what will be interesting. I say if the Fed don't do much with rates and we do see the dollar start to rally, what is Mr. Trump going to say?
You say he likes a strong dollar. That's what you're supposed to say. But
that's what you're supposed to say, yes. But competitive devaluations and the like, methinks. Yeah. All right. Well, I guess we've been talking pretty long enough. I should just quickly round off with the Bank of Japan, which today had its meeting and it's left short-term interest rates unchanged at minus 0.1%. It also kept the target for its 10-year government bond yield at around zero. None of that's any great surprise. But it did also very much underline the fact that it wouldn't hesitate to take additional easing measures if effectively the economy starts to lose momentum again. And again, at the moment, I think, truly the call on the Japanese economy is kind of 50-50. June was quite a good month, but second quarter as a whole was fairly disappointing.
Well, that reminds me, maybe we can close on this, but the comment, I cut a comment out from the Bank of Japan, and it really did strike me. This is almost like a war cry. This is Kuroda saying, quote, downside risks concerning the global economy are greater due to various factors such as protectionist moves and geopolitical risk. And the BOJ needs to pay more attention to downside risks than before. He went on, if the risk raises that the momentum toward achieving the 2% price target will be lost, quote, without hesitation, we will conduct additional easy policy. They're out. This is, you can't get in front of them trying to be any easier, right?
Well, I just think, in terms of, you see commentary like that and you think, well, why didn't they cut today? Because it seems like they've pretty well made their minds up.
Yeah, they don't have anywhere to go either, right? So,
well, it's again, and this is, I suppose, if you want to be negative about the outlook for the global economy, at least your side of the pond, you've got a little bit of interest rate left to cut. For Europe, we're already at zero. Bank of England, if it were to cut, is only at 0.75%. Japan's negative. Switzerland's negative. What do you do?
It's all kind of incomprehensible. So you have to print money and buy bonds, right?
Well, you do that. And I think what we will see will be more and more pressure now on fiscal policy. I mean, I think, Draghi last week, again, was really banging the drum, effectively saying, well, look, monetary policy has kind of kept the Eurozone's economic head above water over the last 5 years or so. It's now a turn of the policy, the fiscal policy makers to come out and start reducing taxes or spending or a combination of the two to make sure that the economy somehow starts to get some momentum again.
Yeah. Well, that's one side. That's one side the U.S. doesn't have flexibility.
Well, I was just about to say it. Europe has space on that, but you don't.
That's interesting. That's an interesting flip, isn't it?
Yeah. Right. Talking of flipping there, we'll flip the end call on that one then. On behalf of Mark and myself, thanks as always for listening. Do remember to keep up to date with all the key market moving data and events in Econoday's global economic calendar, and we'll be back again next week. Bye for now.
Econoday has provided value for the investment industry for over 25 years, amassing a comprehensive, machine-readable database of global market events. Our exceptional dataset consists of consensus, actual reported and revised numbers of economic events. Algorithmic trading firms, global banks, asset managers, hedge funds and AI technology firms are leveraging Econoday's unique historical dataset to fuel their proprietary trading models and support their research and compliance teams. Go to www.econoday.com and follow @Econoday on Twitter to learn more.